Hi and a warm welcome to the Canada Credit Card Expert channel. Today, credit scores. All you wanted to know about your credit score and 5 great ways to actually keep them up. Just before that, here at the Canada Credit Card Expert channel, we would like to share information about credit scores and all relevant information regarding your best selection, usage and benefits out of your daily spending with your credit cards. You are more than welcome to subscribe right at the bottom. So today, credit scores. What is a credit score? Well, that is a number between 300 and 900. You definitely have one. And in fact, you have two. In Canada, we have two agencies, two companies that is. One is Equifax Canada and the other is TransUnion Canada. Both of them would actually have a credit file on your name. The credit file would have a credit score. So you would actually have two different credit scores. Although the criteria is exactly the same, the credit scores would be slightly different. The credit score essentially would actually evaluate you as someone who actually undertook to pay some debts in the past. And now it would be able to evaluate your likelihood of making payments in future. So essentially, your credit score shows a potential lender who you are in terms of your ability to commit to a certain pay schedule. That means that if your credit score is high, you are more likely to be approved for, say, a credit card or a mortgage, or a better rate with a mortgage or a better credit card. On top of it, a good credit score would actually help you with other stuff. It could be something like employment or rentals. So, what is a good credit score? Well, essentially, anything on top of 780 would actually mean a great, excellent credit score. Let's just put the term 5 stars credit score. If you're 780 or up, 800, 820, 840, you are in great shape. Then 720 to 780, that means you have a very good credit score, and that is sort of 4 stars credit score. 650 to 720 would give you a good credit score. Let's just call it 3 stars credit score. 650 is a great benchmark for most lenders when it comes to mortgages and credit cards. If you have anything below 650, then you're starting to have some challenges, or you gotta get some B lenders in the case of mortgages or very basic credit cards. It also would mean that you might have higher interest rate if you wanted, say, a car loan. However, if you are 580 to 650, you are considered a fair type of credit score. That means 2 stars type of credit score. Anything below 580 would mean you have a bad credit score, a 1 star credit score. If you're under 580, we highly recommend you actually watch our video, which is right at the bottom, how to improve your credit score. In order to actually know your credit score, you could do quite a few things. Firstly, you could actually get your credit score totally free by actually signing up to one of the online services such as moga.ca or creditkarma.ca, and then you could definitely see your credit score right there. The CIBC bank application could actually provide you your credit score as well. Creditkarma.ca would give you the TransUnion number. Moga and CIBC application would give you the Equifax number. You could also access your credit score as well as your full credit report by actually having access to RBC online banking. Once you are there, you will be able to actually access your full credit report and credit score with TransUnion. In a very same way, you could actually access your Equifax credit report and credit score by signing up to borwell.com. Once you know your credit score, you'll be able to strategize, and we are going to help you do that later in this video. Equifax and TransUnion are the two agencies in Canada that handle your credit score. Different lenders would actually approach one of the two. So, for example, TD, CIBC, and BMO would approach your Equifax credit score as their benchmark for evaluating your application. At the same time, RBC, American Express, Tangerine would actually approach TransUnion. It is actually important to know your credit score in both agencies. So, How do you get your credit score? Your credit score is actually built out of 5 components. The most important component is history of payments. Normally that goes back up to 6 years. It is essentially 35% of your score. So if you missed payments or you were late with your payments, it would adversely affect your score. 30% would be your utilization rate, balances, and that means how much you're actually using out of your credit limit. So for example, if your total credit limit across all your accounts is 10,000, then you would end up, say, with a balance of 5,000, your utilization rate would be 50%. The lower the utilization rate is, the better it is for your score. The third component is length, or how long you had these accounts. So that means if you had an account opened only 6 months ago, or you had an account opened 6 years ago, obviously 6 years ago would do better for your credit score. 10% would be the inquiries component. That means every time you apply for a new lending product, that would actually hit on your score. If you apply too many times, it would adversely affect your credit score as well. It would actually show that you're after more credit, and that doesn't look good, to say the least. Finally, 10% would go to credit mix. Essentially, credit mix is the type of account you have. That means what type of lending product that you actually get. The 4 types of mixed accounts we are talking about are actually defined as I, installment account, and that is typical for, say, car loans or any type of loan for that matter, which is basically a fixed amount over a fixed period of time that you undertook to actually pay. Then you have M, which is mortgage. Basically, if you have a mortgage, that is a separate type of account in the mix. It is a commitment to pay your mortgage on a weekly, monthly, or whatever it is basis. The next type of account is open. O, that means charge cards such as the American Express, Platinum, or Gold. That means limit per transaction. So your transaction would be approved or not approved accordingly. It will show on the credit report as highest limit. That means the highest amount you had on statement with this particular account. Finally, the revolving accounts, the R, are essentially credit cards. It's a limit you got on the account and you can pay it off at any time, and conversely you could use the whole amount in one shot. That is one transaction, the whole credit limit. So now you got it. 5 components of your credit score. So what would be great ways of actually keeping your score up? Let's start. Number 1, pay off your credit balance each month. Yes, we know you could actually just pay the minimum. However, when you pay it off, you are going to avoid hefty interest rates on anything you did not actually pay off. On top of it, you would definitely keep your utilization down and show good payment history. Number 2, keep utilization under 30%. That is definitely highly advisable. And as a bonus, you could definitely check regularly, once every 6 to 12 months definitely. You might actually get pre-approved offers if you pay well. That means you could actually increase your limit on the account and the lender would let you know online or by simply you calling them and asking them about it. Make sure that such limit increase would actually not entail a full credit check. Why do you want to do that? Well, very simple. If your limit is going up, you don't necessarily have to use it, but at the same time your utilization will actually go down. Remember, if you have a higher credit limit, it does not mean you have to use it. Quite the opposite. Number 3, make sure your accounts, the ones that you have had for a very long time, are actually kept open. So it doesn't matter if you use the card or not, make sure you do not actually close the account. If you don't actually want to pay, say, annual fee on this particular account, you can downgrade or switch the credit card. However, keep longer accounts open. It would definitely help your score when it comes to length. Your score 15%. That is part of the whole deal. So keep these accounts open. Number 4, do not over apply for credit. Do not actually show desperation or do not actually show a potential lender that you actually need more money. So be very wise about it and do not do it too often. And that means once every 3 months is probably a good suggestion to actually go by at the very minimum. And finally, number 5, monitor and strategize. That means make a cohesive plan to increase your credit score constantly. Well, it doesn't matter what the number is right now, you could definitely get it up. All you got to do is just to follow the whole thing that we shared with you today. Most important part is keep budget and make sure you never spend on your credit cards what you cannot pay off at the end of the month. On top of it, make sure you monitor the score so you actually know what to aim at. And pretty much within 1 year, you could definitely increase your score 100 points or even 150 depending on your particular situation. So there you go. You got 5 great ways to increase your score. And on top of it, you really want to maintain a great credit score. You never know when you're going to need it. So, we would like to see you soon again. By all means, subscribe. There is a bell right at the bottom, and we will see you very soon.